There is a fundamental law of the universe. Matter cannot be destroyed, and prices cannot be less than zero. If I give you a bar of gold, you owe me money. If I give you a cup of coffee, you owe me money. This is the bedrock of civilization. But on April 20th, 2020, that bedrock turned into quicksand. In the span of 20 minutes, the most important physical commodity on the planet became financial toxic waste. If you owned oil, you didn't have an asset, you had a ticking time bomb. You would have paid someone, anyone, to take it off your hands. While the titans of Wall Street were vomiting into trash cans, 9 men in a small office in Essex were doing something unthinkable. They weren't panicked. They were buying, and selling, and laughing. This wasn't a fluke. This was the greatest heist in the history of the futures market. No masks, no guns, just a deep understanding of a glitch that the rest of the world was too arrogant to see. To understand how the world broke, you have to understand the plumbing. Most people think the stock market is just numbers on a screen. But the oil market is different. It is physical. This is Cushing, Oklahoma. It is the price discovery capital of the world. It's a massive forest of steel tanks. When you buy a West Texas Intermediate, WTI, futures contract, you aren't just clicking a button. You are signing a legal deed. You are saying, on the settlement date, I will show up at Cushing with a truck, a pipe, or a bucket, and I will take 1,000 barrels of oil. Now let's go to Essex. Meet Vega Capital London Limited. They aren't quants from Harvard. They are local traders. These are guys who grew up in the pits, trading with their gut. Their leader, Cuddles, had been in the game for decades. He knew that the CME, Chicago Mercantile Exchange, had just sent out a boring, technical memo a few days earlier. Most people deleted it. It said, "Our systems now support negative pricing." While the rest of the world was staring at the 0.00 floor like it was a solid brick wall, the Essex Boys realized it was a trapdoor. They used a strategy called Trade at Settlement, or TAS. This is the first win mechanic. They didn't just sell oil, they sold at the closing price. Usually this isn't a problem. Traders sell their contracts to refineries before they expire. But April 2020 was different. The world had stopped. COVID-19 had deleted 20 million barrels of daily demand. Imagine a giant bathtub. The faucet is stuck in the on position, pouring 100 million barrels a day. The drain, the world's cars and planes, is plugged shut. The water is rising. It's hitting the rim. By mid-April, the tanks in Cushing were 90% full. The remaining 10% was already rented by the big oil companies. If you were a hedge fund holding a contract on April 20th, you were in a death trap. You had to take delivery of the oil, but there was nowhere to put it. The smart money realized they were holding a hot potato that was about to explode. They began to sell at any price. $10, $5, $1. But they forgot one thing. The machine was never programmed to go below zero. Imagine you bet a friend that the temperature at midnight will be exactly whatever the official weather station says. Then, at 11:59 p.m, you open every freezer in the city and point them at the weather station. You are manipulating the outcome of your own bet. Between 2 p.m. and 2:30 p.m, these 9 men sold thousands of contracts. Every time they sold, the price dropped. Because the market was so thin, meaning there were no buyers, their selling created a vacuum. They pushed the price into the negatives. Minus $10, minus $20, minus $37. At minus $37.63, the machine finally froze. In that moment, the Essex traders had bought oil at the bottom and sold it at the average. They had effectively locked in a profit of $660 million in 30 minutes. They weren't just winning, they were extracting the literal lifeblood of the global financial system. But here's the terrifying part. To make $660 million, someone has to lose $660 million. And the people who lost weren't the Goliaths of Wall Street. They were people just like you, sitting at home in China, who thought they were buying the dip. While the Essex geezers were likely opening champagne in a suburban office, 5,000 miles away in Beijing and Shanghai, the sun was rising on a Tuesday morning that would destroy thousands of lives. This is the part of the story the market enthusiasts usually skip. Because for every dollar of profit Cuddles and his crew extracted from the machine, a dollar of blood had to be pumped out of someone else's veins. In this case, it was the crude oil treasure, Yuan Yu Bao product, sold by the state-owned Bank of China. It was marketed as a low-risk way for ordinary people, teachers, retirees and Uber drivers, to bet on the recovery of the global economy. The pitch was simple. Oil is cheap, it can't go to zero. Buy now, and when the world reopens, you'll be rich. Thousands of people poured their life savings into this bucket. They thought they were buying oil, but they weren't. They were buying paper. Specifically, they were buying the May 2020 WTI futures contract. Remember the machine we talked about? The one with the pipes and the tanks in Cushing? The Bank of China's algorithm was a passive passenger on that machine. It was programmed to roll its contracts, to sell the May contracts and buy June contracts, one day before expiry. The Bank of China's machine was set to execute its trades during the final settlement window on April 20th. They had 60,000 retail investors all bunched together in a single, massive exit door. Imagine a crowded theatre. Someone smells smoke. Everyone rushes for the one exit at the same time. Now imagine that outside that exit, there are 9 men from Essex holding the door shut, saying, "We'll only let you out if you pay us $37 per person." As the Essex traders hammered the sell button to drive the price into the negatives, the Bank of China's automated system was forced to sell. It didn't matter that the price was minus $10. It didn't matter that it was minus $30. The algorithm had a mandate: get out at any cost. One investor, a man identified in local media as Mr. Lee, had invested $10,000 his daughter's university tuition. He woke up to find that not only was his $10,000 gone, but his bank was sending him a bill for an additional $30,000. Think about the psychological horror of that. You invest in a commodity. You think the worst-case scenario is, I lose what I put in. But because the machine broke, you now owe the bank 3 times your initial investment because you technically paid the Essex traders to take your oil. The Bank of China was facing a $1.4 billion loss. But as the protests began to swell outside bank branches, a secret meeting was happening in Chicago. The CME, the exchange itself, had to decide. Would they honour these impossible prices, or would they hit the undo button? The stakes were no longer just about 9 traders or a few thousand Chinese investors. The stake was the integrity of global capitalism. If the CME cancelled the trades, they would be admitting that their free market was a sham, that the house only lets you win if it doesn't hurt the big players. If they didn't cancel the trades, they risked a diplomatic nightmare with China and a total collapse of the oil futures market. They chose the pain. They allowed the settlement at minus $37.63. While the world was mourning the death of oil, a very specific group of people, the ultra-wealthy, the commodity titans, and the sovereign wealth funds, were salivating. They weren't looking at the minus $37 price as a tragedy. They were looking at it as a mathematical gift. To understand why, you need to master one word: contango. In a normal market, oil today costs about the same as oil in the future. But on April 20th, we entered a super contango. The price for oil today was minus $37, but the price for oil delivered in 6 months was roughly plus $30. That gap represents a $67 spread. In the world of finance, that isn't just a profit margin, it's an infinite money glitch. This is where storage arbitrage comes in. If you were a billionaire on that day, your play wasn't to trade on a screen. Your play was physical. Here was the masterclass move. Step 1. You rent a massive oil tanker. At the height of the crisis, renting a VLCC cost about $150,000 a day. Step 2. You buy 2 million barrels of oil at -$37. Remember, they are paying you to take it. You just made $74 million for saying yes. Step 3. You immediately sell a future contract for 6 months from now at +$30. You have now locked in a guaranteed sale price of $60 million. Cash received for taking oil, plus $74 million. Guaranteed future sale, plus $60 million. Cost of renting the ship, 6 months, minus $27 million. Total risk-free profit, $107 million. You didn't even have to move the ship. You just sailed it out into the middle of the ocean and dropped anchor. You sat there for 6 months, drinking gin and tonics on a yacht, while your floating warehouse sat on a literal ocean of gold. This is why, if you looked at satellite imagery in May 2020, the coastlines were clogged with ships. They weren't waiting to unload, they were waiting for time to pass. The ultra-wealthy were arbitraging time itself. You might ask, why didn't the banks just stop the Essex guys? Why did they let the price go negative? Because the system values settlement over sanity. In the eyes of the CME and the clearinghouses, a negative price is just a data point. The system's only job is to ensure that if Party A loses money, Party B gets paid. If the system stops to ask, is this fair? The entire global web of trust collapses. The relief wasn't that the price went back up. The relief was that the pipes didn't burst. The money moved. The Essex guys got their $660 million. The Bank of China retail investors were wiped out. The machine proved that it could handle even the most impossible scenario, total sub-zero collapse, and keep on ticking. Usually, when 9 guys walk away with $660 million in 30 minutes, the next sound they hear is the kick of a front door and the click of handcuffs. But for the Essex geezers, the sirens never came. Instead, they got letters. Thousands of pages of legal demands from the Commodity Futures Trading Commission, CFTC, and the Chicago Mercantile Exchange, CME. The question that kept the world's most expensive lawyers awake at night was simple. Did Vega Capital find a hole in the market, or did they dig one? This is the battle for the grey zone, the thin, blurry line between being a market maker and a market manipulator. Under US law, specifically the Dodd-Frank Act, market manipulation requires specific intent to create an artificial price. The regulators looked at the Essex traders and saw a smoking gun. They pointed to the fact that these 9 men were selling simultaneously. "Look," the regulators screamed. "They aren't trading against each other, they are trading as a pack. They are flooding the market with sell orders at the exact moment the price is most vulnerable, specifically to drive it into the negatives so their trade at settlement contracts would pay out like a broken slot machine. In any other world, this is called spoofing or banging the close. It's illegal. But the Essex defence team had a counter-argument that was as brilliant as it was infuriating. They weren't creating an artificial price. They were revealing the real one. The defence was simple. The oil market was already dead. The tanks in Cushing were full. The Bank of China was a forced seller. If Vega Capital hadn't been there to buy those contracts at -$37, the price might have gone to -$100 or -$1,000. They argued that they provided liquidity. In the grey zone, a manipulator is someone who tricks the market. But you can't trick a machine that is already crashing. You can't manipulate a plane that is already in a nosedive. You're just the guy betting on the crash. This is why Cuddles wasn't arrested. To prove manipulation, the government has to prove that the price wouldn't have gone negative without them. But because the entire global economy had stopped, the regulators couldn't prove what a fair price for oil was. Is fair $20? Is it $0? Or is fair whatever someone is willing to pay you to take a toxic asset off their hands? The true heist wasn't in the selling, it was in the math of the TAS contract. TAS allows you to trade at whatever the closing price ends up being. By selling the physical oil and holding the TAS contracts, the Essex traders created a self-fulfilling prophecy. The more they sold, the lower the settlement price went. The lower the settlement price went, the more their TAS contracts were worth. It was a closed loop. It was legal because the CME's own rulebook allowed it. The villains didn't break the rules. They used the rules to break the players. Understand this. The regulators didn't go easy on them because they were nice. They went easy because if they admitted the Essex traders manipulated the price, they would have to admit the entire CME exchange architecture was flawed. To protect the machine, they had to let the Essex geezers keep the money. We are now years past the day oil went negative. The headlines have faded. The Essex traders have retreated into the shadows of their millions. But the glitch they exposed is more present today than ever before. We are living in an era of inelastic markets. This is your 2026 survival guide. An inelastic market is any system where supply or demand cannot change, no matter how much the price moves. If you want to spot the next $660 million opportunity, or avoid being the next victim, you must look for three things. 1. Physical constraints. Is there a cushing? Is there a limit to storage, bandwidth, or electricity that cannot be bypassed? 2. Automated necessity. Is there an algorithm, like the Bank of China's, that is forced to sell or buy at a specific time, regardless of the price? 3. The floor is a lie. Never assume a price can't go lower. In a digital, automated world, the floor is just a line of code, and code can be rewritten. The Essex geezers showed us that the economy isn't a mountain, it's a series of pipes. Sometimes those pipes freeze, sometimes they burst, and sometimes they flow in reverse. Look at your investments, look at your career, look at the systems you rely on. Ask yourself, if the drain clogs tomorrow, am I the one with the bucket, or am I the one drowning in the tub? The day oil went negative wasn't the end of an era. It was the beginning of the age of the glitch. The machine is running. It's faster, leaner, and more dangerous than ever. The question isn't whether the machine will break again. The question is, will you be watching the screen? Or will you be the one who knows how to play the negative numbers?